As I'm concerned, the guy is a major loser. He talks about charity. That's complete. He's not giving it to charity.
Let me remind you that we are on live television.
This is not an honest guy, and this is not a guy who keeps his word, and this is a guy who takes advantage of little people.
Today, folks, one of the most significant impacts on my entire investing career from an educational standpoint was the billionaire battle between Carl Icahn and Bill Ackman. Now, if you've never heard of these guys before, you're going to get a really fun, just educational piece, a historical event that's finally unwinding into something that's just astounding. Now, Icahn Enterprises, the company that Carl Icahn runs, was really pronounced for paying a super high dividend yield, and right now it's at 38%. I'm telling you, that's going to get cut. That ain't going to be around for much longer. But this thing is finally unwinding. As Buffett says, when the tide goes out, we get to see who's swimming without shorts, and that turned out to be Icahn Enterprises. Now, Bill Ackman was accusing Carl Icahn of basically running a Ponzi scheme with one of his holding companies, Herbalife. Again, keep in mind, this was around 2013, 2014 timeframe, and it's kind of crazy to think Herbalife is finally getting below those levels in this current market environment, which really goes to show you, if you have the balls to short stocks, it is a long game. It is not something that might just unwind overnight. Yet none of this has to do with Herbalife. Now, Bill Ackman runs this thing called Pershing Square Holding, which basically is an investment company. I think he's got ownership in things like Chipotle. Does a really good job at turning businesses around, worth $7.2 billion. Right next to Icahn Enterprises, worth $7.6. They're almost right in line now after the recent sell-off. But let's break down the events that have unwound this stock, and it's just ruining investors' days. Now, again, I'm going to leave you with a little tidbit of advice. If you want to learn something that stuck with me forever, it's called William Ackman. Everything you need to know about finance and investing in under an hour. They break down like a lemonade stand and show you how balance sheets work. It's probably one of the best videos ever. It's got 10 million views. I'll leave the link down below. But let's get into this. One of the biggest problems right now is Icahn Enterprises. The majority stakeholder is Carl Icahn. So you see where it says held by institutions? I don't know why it says institutions, because over 80% is literally held by Carl Icahn, and he's pledged a lot of these shares, and he has a lot of margin debt backing these shares, which is leading into this kind of I don't even want to call it a Ponzi scheme. It's just an unwinding, an unfolding of unforeseen debt. And this has a lot to do with comparables to even Elon Musk, trying to set up the Twitter deal, which was disclosed. A lot of what Icahn did was not disclosed. We'll hear more about it in a CNBC interview, but Bill Ackman made a tweet, and I'm just going to highlight a few points. Now, I've been fascinated by the Hindenburg Re IEP situation. Now, for those of you that don't know, Hindenburg, a really famous reporting company, they took down Nikola, and it's weird how shorting works these days. I remember when I started investing, learning about shorting stocks, you kind of pick low float, kind of penny stocks that just don't have a bright outlook, short them, get a collection of shorts, and hold on to them for 5 years and wait. Now it's like, if you're going to short a company, you might as well work for Hindenburg. You take the short, you write the article, you release it, and you make a bunch of money. But nonetheless, there are some interesting learnings here. For example, one learns from IEP that a controlling shareholder of a company with a small float that pays a large dividend can cause his company to trade at a large premium to intrinsic value. Best approximated in IEP by its NAV per share. I think the company's worth like $15 is the NAV price, the net asset value, if you minus the liabilities. If they sold everything today, kind of something similar to REITs. The premium to NAV creates liquidity for the controlling shareholder by enabling him to access margin loans secured by overvalued shares that can be caused to fund investments. So again, like Elon Musk leveraging his Tesla shares to perhaps, buy something like Twitter. He's taking leverage out. So if the stock tanks miserably, that loan becomes a little shaky, and who knows, the banks might call the loan, right? The IEP premium has been sustained by a large dividend yield, which is not supported by operating cash flow. The yield is generated by returning capital to outside shareholders, which is in turn funded by the company selling stock to investors. So basically, they're probably issuing shares, raising capital, and using that to pay the dividend, which again, very nefarious things. You can only do that for so long. And apparently they've been doing it for a while. This system has worked for a considerable period of time, but it is highly dependent on the maintenance of the premium and the placidity of Icahn's margin lenders. IEP stock held by Icahn is not a liquid asset, as it represents approximately 85% of IEP shares outstanding. Like we looked at the institutional ownership. The shares also reportedly represent 85+% of his net worth, so he apparently does not have much outside resources to draw upon. I'll finish up with a few more of these anecdotes, but a sustained premium requires confidence in Icahn and IEP. If Icahn Icahn were to sell any shares, the stock would likely drop precipitously, as the overhang of additional sales and the further resulting loss in confidence would catalyze other shareholders to exit before the deluge. The problem Icahn has is that this system has been outed by Hindenburg Re. Transparency is not the friend of IEP, having caused a more than 50% decline in the shares, which has caused Icahn to post more shares, now more than 65% of his holdings. Further declines over the last several days will likely require additional postings. Now, if we scroll down to the end here, because he just kind of breaks into some more technical aspects of these margin loans and stuff, but I am surprised that Icahn has not disclosed the terms of his margin loans, including who provided them. My understanding of the SEC 13D rules is that they require disclosure of source of financing and even copies of financing agreements, although many investors ignore these requirements. Now, Icahn's favorite Wall Street saying is, if you want a friend, get a dog. Over his storied career, Icahn has made many enemies, and I don't know that he has any real friends. He could use one here. We are neither long or short, just watching from a distance. I'm really surprised. I wouldn't be shocked if the dude has short interest personally, because I mean, this is something that was so rooted in his soul and so against this company that I mean, publicly he probably won't say that he has shorts, but I wouldn't be surprised in his personal name if he does outside of Pershing Square Holding. But here's a few highlights of CNBC just discussing this today.
It's clear that IEP has been paying out dividends totally unsupported by cash flows and trades at a massive premium, which is really unusual. It belongs to this sort of sector of these closed-end funds, which usually trade at a discount or a very slight premium to book. At some point, this thing was trading at 2-3 times book. I think book value is around 15 or 16 bucks a share, so it's starting to come down, but it's still trading for more than the sum of its parts, which is pretty unusual. If the stock continues to fall, he could have a real problem, which is that he's pledged about 60% of his shares in the company to loans. We don't know a lot about them.
Well, that's what I was going to ask. Do we have any sense of where the demarcations are in terms of, as things fall, what's been pledged at what number?
Not at all, which is really unusual and frankly raises some governance issues. If most companies have really strict limits on what their CEOs can pledge at what levels, and even if they do, they disclose it. I mean, say what you will about Elon Musk and Tesla. Like, we had a lot of information about how much of his stake he had pledged and where, and when he went to buy Twitter and those margin loans, we knew exactly how fall.
There's been comparisons online to the likes of Carl Icahn being like Warren Buffett, but in a more aggressive manner, offering almost, very great returns to some degrees. But I can't get over this. It's like this story from 8 years ago that resonated with my younger investing self is kind of coming full circle, and it's truly nostalgic. But I'd love to know what you think in that comment section below.